I'll split it in two parts. I had a professional training and a personal. The professional training, I went to GW, George Washington University in Washington, D.C., and did some internships during school, including at Deutsche Bank and a few other firms. And then eventually during school ended up at a firm called Aegis Financial Corporation, which is another value manager. But in terms of my personal investments, I started investing when I was 12 or 13. I owned stocks personally that some parents' friends had given to me, and I found it utterly fascinating. So that was the beginning of the journey for myself. Well, I think curiosity maybe is the most important. It takes a lot of work, obviously, to read through all these companies and study businesses and industries and economies and so on. And if one is not curious about the world and how it works, particularly in businesses and so on, it would be pretty dull life, I can imagine. So I think that's maybe the most important. And then secondly, maybe equally as important, is patience. Our kind of style of investing, as you know, is takes some time to play out generally, and if one loses their patience and is in the business to get rich quickly, they won't have a good time doing it. So that's how we think about things. But I would say those are probably the two most important attributes. Sure. Yeah, it's a great question. I would say we try to aim sort of for the middle. What we try to find companies that have an intersection of both high quality but also extremely cheap, more on the Graham side of things in terms of quantitatively cheap. So if I had to answer your question, it would be maybe sort of in the middle or slightly more toward Graham with an exceptional business involved. They're not easy to find, and we only find a few, but that's the idea. Most people, as you know, define risk as volatility, in which we do not. The way we view risk is a permanent capital loss. Often the stocks that we buy, because we tend to be too early to a situation, we will buy them and they may decline in some way just after we buy them. And so as long as our analysis is correct, generally speaking, they come back. Not only do they appreciate, but then we have a sizable return. That's the idea, at least. And so our risk is, as I say, a permanent capital loss where the company has too much debt or for some reason goes out of business and we lose our investment. That's really what we're concerned about. We don't hedge. We manage an investment partnership that is traditionally known as a hedge fund, but we don't hedge. We have cash in the portfolio, and part of the reason is because we don't find that there's a way to hedge. We're buying smaller companies, and there's no real great way to sort of offset that. So we prefer to sort of analyze the businesses and think about as we're buying the businesses and not worry about short-term price movements. We have about 15 names, generally 15 stocks in the portfolio at any one point in time, and we're big proponents of concentration. A variety of reasons. One, we think that roughly at about 15 stocks after that, the power of diversification tends to erode, and therefore you're sort of being average after that point. We also like to know the companies extremely well. Our goal is to know the companies as well as that is better than any other investors in the market, and to be able to do such a thing, you really have to spend a significant amount of time studying them, and so that would obviously be impossible for 100 stocks. So my partner and I tend to study, this lower number to try to get to know them, and also obviously that to that extent that you find something you really like, then and it does well, you capitalize on all the work that you put in. So that's the way we think about things. The turnover is about 20%. So generally, we're looking at things for about 4 to 5 years. We prefer to own them even longer than that. We've had some long-standing positions, but that's sort of generally how we look at the world. We sell them for 3 reasons. One, they reach fair value or very close to fair value, and it's not in a business that is continuing to grow. So at that point we decide to sell. The second reason might be that we find another investment that we think is better. We sell stock A for stock B. One must be careful there because sometimes you can trick yourself into thinking that the other one is better, and unless it's materially better, we tend not to be active. And the third reason is that we've figured out that we made a mistake, and so after that conclusion is definitively reached, then we decide to move on. So those are the 3 reasons. We try to focus on the mistakes. In fact, when we write to our letters to our investors, we try to virtually almost completely talk about mistakes and drawing lessons from those rather than the more successful outcomes. We think that it's very instructive to do that and to not have a culture of hiding mistakes, but instead embracing them. There's a quote that the Ed Catmull at Pixar wrote, and it said there's glory in making mistakes, and I think so studying them and trying to figure out what you did wrong and obviously constantly trying to improve is very important. We look in two places. One is screens. Many people say, oh, screens are, everyone's doing them, you can do them, anyone can do them, and they do. But even today, because of institutional reasons, constraints, or because of the fact that we're looking in areas such as Greece that are extremely out of favor, many people, even if they find a quote, cheap stock in Greece, are not interested in investing there. So that's one way we look for stocks trading at very low valuations. And the second reason is we have, or second way, excuse me, is that we have a rather deep relationship network around the world of other value-oriented managers, and we spend a lot of time getting to know people and trying to be helpful to each other, and so sometimes we'll develop ideas that way as well. That's a tough question. I would say it really depends on the industry. There's no, I would say, one thing that works for, one metric that works for all companies. In the case of financials, book value is obviously important, and those kinds of things. In real estate, it's cap rates and other things. So they're all sort of a variety of, a mix of the same idea, but just looked at in a different way. So we try to sort of find the relevant metric, but one also must be sure not to drift in terms of trying to make excuses for higher and higher valuation. So we try to be quite disciplined and strict in that way when we are looking at a specific metric. We don't have any favorites. We try to be quite agnostic and as long as we can understand the business, but along those lines, we tend to avoid healthcare, defense, and technology businesses. I would say fast-moving technology. As you know, there has been a lot of money made there over years, and we're fine to let other people make the money. We just can't figure out exactly which one is going to do that. So we tend to avoid these more dynamic industries. But other than that, we're rather agnostic as long as it's a fairly simple business to understand.